Welcome, good afternoon. Welcome to this session entitled Designing Deals for Successful Exits. My name is Charles Human. I'm Managing Director of HBS's brokerage and advisory businesses in Europe. We have a top-class panel to debate this subject, starting from the end, Gabriel Peterson, Managing Director of Blackstone, Desmond Talliard, Managing Director of Hotels at London and Regional.
Hello.
Andy Lancaster, Head of Hotels UK Sector Coverage at RBS. And isn't it great to see that RBS are back again sponsoring this conference? That's got to be a very positive sign. Ellie Younis, Head of Group Development at Residor Hotel Group, and
Hello.
Mathieu Everard, Chief Development Officer at Louvre Hotel Group. So the subject is designing deals for successful exits with a neat little subheading, options to terminate contracts on sale for what you need to look for. So there's something interesting to debate there. I think it's fair to say that compared to this time last year or even 6 months ago, we're in a very different environment for selling hotels. We're now at a point where you don't necessarily sell simply because you need to or you're under pressure, but there are some compelling reasons for exiting to optimize value. So we are, thankfully, in an environment where a sale is easier to achieve. We'll try to cover a pretty broad range of topics, ranging from timing through to management issues, asset management, financing, and some of the more technical aspects. But let's sort of start big picture. Gabriel, you've been through the cycle, buyer and seller. When do you start to think of an exit? When you buy, have you got your exit in mind? Is it as early as that? And given what's happened over the last 5 years, how is it all borne out in the end?
Yeah, I mean, the first part of the question about, yeah, obviously we have to, when we underwrite the deal or the transaction, we have to have a certain holding period and factor in the exit and what we expect the exit to be. Of course, there's a lot of guesswork because you cannot tell what multiples and cap rates going to be 5 years from the day you buy, but there's, broadly you have to come up with something to manage to underwrite your deal. So there is a strategy in that sense from a financial perspective. Then the strategic side of things, where depending on the portfolio you buy, the asset you buy, or the market you're buying, you can pretty much try to guess what would be the type of buyer that will be buying your asset or your portfolio 5 years down the line, after you, of course, reposition it, rebrand it, or whatever it is that you're doing to the portfolio. It will be suitable for certain type of buyers. So you will be targeting or expecting to sell to a certain type of buyer as well. So, and of course, it will depend on the financing market. So, obviously, how much is Andy lending the buyers and so forth. So it's a whole array of things. But yes, we try to come up with something which is, of course, subjective to an extent. But there is a timeline, and when we are a private equity fund, obviously, so we cannot be buying assets and thinking about 10, 15 years. We think about quick kind of turnaround situations and selling within 5 years. Your question about what happened in the cycle, when you get hit by one of these downturns the size of the one we've been hit, that means that your 5-year hold will most likely be longer because you don't want to be selling when the whole world is collapsing. So you try to hold on to the assets, keep asset managing them very, hardly, and exit when you see the thing starts to recover, which, as you said, I think we are getting to that point where we are seeing some more positivism and optimism in terms of transactions. So we already started to sell a few assets last year, and we will continue doing so, of course, of the old assets, right? So.
Desmond, you've moved from sort of pure PE funds to property company, whatever you want to call L&R. That's more sort of finite time strategy, the 3 to 5 year hold to an organisation which, from what I can see, doesn't sell very often. Does that influence the buy at L&R?
Well, is it a benefit or burden of actually having worked for a brand company prior to that? So I was trying to compare and contrasting, thinking about the topics on the way over here. Brand companies were buying assets specifically to put a brand on, then almost flipping them. Back in the old days when companies like Hilton had things called cash, they used to buy hotels and to secure gateway city representation and then sell them on. Starwood Capital, you're absolutely right, a PE fund with closed-end funds, a definite timetable. So the theory then that you, my old boss there, a chap called John McCarthy, actually Adia now, used to talk about the 3 E's, that when you acquired an asset, you were doing entry, execution, and exit all at the same stage, and that would be hypothesized going into the deal, consistent with what Gabriel's been describing. And now, you know, it's a privately held investment company. It's quite interesting because you're buying for opportunity, but also optionality. I think the things that we're looking for is the ability to grow cash flow and either bringing refinancing, capital through refinancing or development or enhancement, or just sit there because it's a cracking asset and get a yield and to ride the capital appreciation. So 3 very different perspectives for me, and actually influencing a lot how it's debated. There was a defined objective in a branded company. Starwood Capital, to your point again, loads of high. The one thing you guarantee about any feasibility or plan is they'd always be wrong.
Yeah.
And in fact, some people used to joke that when you got lucky in upswing, it was because the model was wrong, and that's why we bought it. But you know, luckily the things turned around. So those are much more, I think, pressure is maybe not the right word, but there is a tension in the acquisition that you're only going to realise it on the value on getting out, and that's a different environment to where I am now. So I do think you're driven by the capital objectives as to how you focus on exit. But my view today, we're very much focused on optimising optionality in those choices.
Would you agree, though, you make the money on the buy, not the sell?
I would not, actually, unless there's a bonus involved, and at which point which side of the table I'm sitting on. But actually, some of the transactions Starwood Capital were, some of the more interesting transactions we did that are now in public domain, were buying a portfolio and having some residual bits and pieces. You'll be familiar with a hotel in Warsaw, for example, that came in the rag bag of significant assets, and that was the asset management repositioning and the time of that exit was, you know, we didn't even consider the value of that hotel when we bought it. It was kind of on the fringes. So I don't agree that the value is solely created or even substantially created on the acquisition, unless I become acquisition.
How do either of you decide when to sell? There's one fairly substantial REIT out there who has an interesting annual program. They analyse each property and they decide, would we buy this at the value we can sell at?
If you're not a buyer, you're a seller. It's the old adage. There are some interesting cultural challenges when you sell. Are you prepared to accept that the next guy is going to make some money or not? And I don't know if people have been, you know, in the discussions this maybe has the residents have said, well, what are we missing? What is the other guy doing, you know, that we've forgotten? And you can get yourself into a paranoia of that. And ultimately, if the deals deliver the returns and the timing's right, why wouldn't you want the guy to make money? How does your employer cope with that paranoia?
Typically, yeah, no, I agree with that. You have this, I think the ideal case would be when if you're achieving a price that works for you on your deal and you're making the returns you were expecting on that deal, you shouldn't be thinking what is the buyer making or not making. That's it. You should, of course, you need to make sure that you're getting the best price for that asset at that point in time. But other than that, you should be willing to sell. On the point about whether you make the money on the acquisition or the sale, I think one of the big differences is that on the sale side or the sale timing, you have a lot more control and you can influence much more than actually what you make on acquisition. Acquisition, you have to buy at a certain price because the seller wants to sell at that price, or there's a whole wide marketing process, so you have to pay a certain. Of course, you have to be comfortable with the price, but from the time you buy until you sell, you have 5 years for you to influence that sale price. Like repositioning, rebranding, what Desmond was just saying. You can also pick the price, so the timing of the sale. You can sell this year, next year. So you can influence much more the outcome when it comes to sell. So I think, of course, it's important to buy well, but what you do with the asset and how you sell it also makes a big difference.
Right. Matteo, you've done some large-scale sale and leaseback, sale and franchise back. Talk to us about those and how did timing the markets drive that and the type of deal you put together?
Yes, indeed. Well, first of all, Louvre Hotels, as a quick introduction, we own and operate 1,200 hotels, and on the balance sheet we have about 300 hotels. So as an owner of brands portfolio of brands and owner of asset, we have to play a bit between the two aspects of the business. We have initiated a few years back an asset-bright strategy, as we call it, which means that we have some assets that has been on the balance sheet for 25 years. So, as your point of having an exit strategy at the time of the entry point is a bit difficult to say from the family-owned business. So we started to analyze where we can reposition some hotels with the offensive capex repositioning. Some of the non-strategic assets, which are low contributing EBITDA assets, let's say in our global portfolio, which we feel would suit more to franchisees, and that's why we've started a sale and franchise back process. And in between the two groups, we are considering doing sale and management back. So that's why we are playing between the asset plan and the brand plan or operation plan, is to mix the short-term profit and long-term operation. Just one word on the sale and leaseback. It was more a refinancing exercise than a strategic exit, because it gives less liquidity to the asset once you hold the going concern with a long-term lease. So we are considering that more as a refinancing exercise than a strategic plan.
To what extent, though, did buyer requirements or appetite influence the way that you've structured your deals? There's clearly, I would say, most appetite for, if we ignore unencumbered sales, there's most appetite for franchises and leases, least appetite for management contracts. So did that steer you away from the management contract route?
Well, first of all, designing deals means we are kind of artists. Okay? Mm-hmm. So we are designing and very creative in finding the right exit. Again, to your point, we are hotel operators, so we have the exit from our portfolio is not the end of the cycle, because it begins a new partnership program with the new buyer. So we have to find the right balance between short-term profit and long-term value.
It's a cyclical thing as well, of course, because in the early noughties you could not have done a sale and management back along the lines of an LRG. I think the market had to mature and become relatively more sophisticated with series of performance-related leases before it would get into managed back and before it could mature, let's say, into sale and franchise back. So a lot of what drove earlier transactional function, I think, of what the funding markets or even the real estate institutional markets would have an appetite for, and you could almost see the maturity from sort of teenager sale and lease back into the more adult and accepted sale and managed back.
Yes, indeed, and to have a link with Gabriel on the finding the right buyer for this portfolio and designing our exit from this is again with the sale and franchise back business is low contributing asset, like generating between 50 and 100K a year is very little operation cash flow for a big group like us, but it's a very nice incentive for local franchisee. Would be happy to play with that. So finding the right buyer for our portfolio is the way we see the exit.
So let's bring the owner-operator relationship into this. So sort of premise number one, a hotel subject to a plain management contract is the least marketable type of asset. Do we all agree that that's...
That's an assertion. That's not a premise.
Okay. It's a given.
What was the assertion again?
Management contract.
Yes.
A hotel subject to a management contract is the least liquid form of hotel investment.
Who agrees with that?
No one.
Nobody agrees with that.
Well,
okay, let me put it another way.
Try turning that to Intercontinental in Park Lane. That's sold with a whole series of buyers and an army of people queuing up to buy. It'll be driven by the factors of the underlying asset.
Okay, but if unencumbered, it would have sold for a higher price.
Yeah. It's more value.
Higher price than what?
than it sold for, if unencumbered.
Would it?
Anyway, where I'm going is to investors and financier.
Well,
You're
it
buying,
depends
if you're,
what
let's say you're buying,
It depends what you're factoring the value to the legacy brand that's left on that. So
I'm just saying absolute number.
I think that's a reasonable assertion.
Okay. So you're buying an unencumbered asset and you want to put an operator in place. How important is a break clause in a management contract?
Extremely.
I think Gabriel's going to sit on the fence on this one.
To defend the operator, you know, in the execution part of the transaction, the operator has delivered some sort of value during your whole period. So why would you say this is an encumbrance to have an operator on the asset?
No, you will continue having that value. An operator will still be running it, but you just have the option when you sell to tell the buyer, it's your choice. If you want to keep these guys or someone else. So that optionality, however you want to value it, it has some value. I mean, we see it constantly. We sell encumbered assets, unencumbered, all sort of stuff. And you see the difference immediately. Even the number of buyers interested in unencumbered assets is much bigger than encumbered.
So would you say it's the most important factor when you're negotiating a management contract?
Yes. When you're negotiating a management contract, yes.
It's to not have a management contract.
And
to have some...
assuming you could take this a step further and...
Yeah, when you're bringing a brand, right? If you just want to brand one of your hotels, or you're repositioning an asset and you want to rebrand it, and then, part of the discussion has to be, you give them whatever number of years, but you can terminate it. I'm not saying without notice, and of course you can agree to terminate with a certain penalty or high penalty, whatever you want, but it has to be terminable, because what happens is all this long-term 30-year management contract, which we still somewhat live with, you just cannot. You have no flexibility whatsoever.
I think common sense has to prevail at some point into this. It is understandable from an operator's perspective the potential need for a buyer to amplify his value, to increase his market value, to have the asset encumbered, and I think everybody can understand that. I think the question is how you would commercially structure that, and the little friction is when the operator is performing, maybe overperforming. The owner decides to sell his asset, and he wants to sell it unencumbered. How fair is that to sell the asset unencumbered? And if we jointly decide that it is fair, maybe the penalty should be much higher. Then would the operator
or if you
have
call
been
it a reward in that
under-
circumstance,
well,
because your
reward,
cash flow
probably.
would be above the
But by the way, if
competition.
you're performing so well, it is quite likely the new buyer will want to keep
I
it.
think that's a really important point. I mean, my theory is that if the existing management agreements did not have such an aversion to it, the market would accept it more. Most brands are worried about the precedent being set. It's kind of breaking the seal of having that introduced. It would be interesting enough if we took an overseas brand into the UK in a different life of mine. It was, desperate's not the right word, extraordinarily keen to get into that marketplace, and therefore the owner had a lot more negotiating influence, shall we say. But it was a very aligned. There was a reward for termination in the event of a sale. They had, we'll come on to non-disturbance agreements in a minute, that will get us all entertained. But there was also a participation in an IRR look-back performance. So they were completely aligned in driving you up the rate of growth of your cash flow. And this brand was going to be so good, they said, you know what? If we're that good, who's going to change us? And if we do, we get a nice kiss. The problem I see with the sympathy with the brands is that's okay in isolation, but if it's taken you 20 years to put your brand in London or Paris or New York, it's a pretty tough life if Caprice as much as anything else, you're sold 2 days later, and you get a nice kiss off to take your flag down. But actually, on the other hand, if you're brand development director and your job is to open one hotel every decade, your job starts again, so you might be quite happy. I do think the brands, if they didn't have their existing, I don't know if stubbornness is the right way, but their feet dug into the lengthy contracts, they would be more flexible. But then I think, the question for really Ellie, where you've got, I think, more emerging market potential than more established brands, would be to say you've got more license to be creative.
Yes, and we try to be. Look, I think the concept of breaking a contract upon sale is an acceptable concept to operators, especially in today's market. There's always a minimum that the operator would want to save face, let's put it at least 5, 6, 7 years, beyond which maybe you can work, structure together a commercially viable model, whereas the owner can terminate the contract on sale. But if indeed the operator has been performing at the time of termination, the odds has to be on the operator's side. And if it commercially, and if the operator hasn't been performing at the time of the sale, then the operator has to swallow the bullet.
Andy, what's the bank's viewpoint on this?
So I think from a lender's perspective, it forms part of the sort of broader analysis of a transaction that we conduct really at the start of a deal. So the equity story, the exit strategy, and some of the sort of finer points of detail that we're talking about here around management contracts. I guess it's a classic case of flexibility and negotiation. So we don't have a sort of a fixed template that we have to shoehorn everything into. We are open to discussion. But I guess ultimately...
But if the owner says, I want the right to change operator or kick out an operator, I mean, some banks in pre-2008 were almost stipulating that their funds advance were predicated on keeping that operator in place. Would you say the banks have learnt a bit from that lesson or not?
Yeah, I think probably the answer is yes. But I guess ultimately we're all the parties around that table, the owner, operator and the lender are trying to retain maximum flexibility in a variety of different scenarios. So in a lender's perspective, in an orderly exit, or unfortunately on occasions in an event of default, we're seeking to retain flexibility in that process. So we're going to be conflicted against the operator at that stage, and I think it comes down to commercial negotiation. We fall sometimes we fall either side of that line.
But there is also cases of where the operator is being victimized. What is the operator's fault if a banker and an owner decide to over-leverage a property in 2008? The market went down, the property went bust, the owner went bust, the owner put his hand on the asset, and then they look at the operator who's performing and tell him, well, you know what, I don't like you, I want to kick you out. What's the reasoning behind that? Is this fair?
I'm not sure if it's I don't like you. It's just, I just lost all the equity at nothing.
Sure.
It's not a fair
I need
balance
to
of
try and
pain.
recover something.
What's that?
It's not a fair balance of pain, is it? You've lost a couple of years' income. We've lost the entire equity.
I think the ideal scenario is that and this often doesn't happen because of the timing of negotiation of the hotel management contract, often before financing, is the ideal scenario is that all parties are around the table at the same time, and then you craft, in a blue sky world, you craft a scenario where everybody sees an exit and they think it's equitable, but that's a blue sky world, and often we're not in that place. So it does fall down to the balance of power often, where the desire is greater.
I have a question for you. What is your appetite today to sign non-disclosure agreements with operators when they say contracts?
Non-disturbance.
Non-disturbance.
Yes. Sorry.
Again, I want to be careful that we don't I don't talk about policy because they're
Without being black and white, of course.
because we do, but it's flexibility. I think our starting position would be to retain maximum flexibility, so to not sign NDAs. Would be
But you will need the asset to continue being managed, right? As a lender, you need, if the equity goes away or defaults, you need the asset to be managed. So you have a bit of an interest as well for the operator to be there, at least to stay there while
we do. And the commercial reality of something is if for whatever reason we're in a default scenario and for a variety of performance metrics the operator has performed well, but we're in that scenario for different reasons, then it's highly likely that yes, we would want that operator to remain in place. So we'll be aligned in that scenario.
Just to make Ellie happy here. It's not, for example, we just as example, we sold 3 assets over the last 12 months. 2 were terminable contracts with Starwood, Hilton brands. The buyer decided to keep them, and we sold them. The buyer kept them there. We sold also a long-term management contract. Of course, they're still there, but it's just the flexibility because we sold unencumbered.
Fair enough.
So the brands proved to be good at what they were doing. The buyers liked them, and they're still there. So it's like, yeah, if you're performing and you prove that, you're doing well, as you were saying.
But if you can translate that in the contract, it would be nice as well.
Well,
If you're performing, and if you're doing X, Y, and Z, then
yeah, but
the buyer will like it.
Have you ever taken either operator an incentivization package, if you like, on an exit, rather than just a multiple of fees?
Can you repeat, please?
Would you take have you ever been asked or agreed to take a slice of the price above a level, as opposed to a...
We have just been asked on 2 deals that we haven't signed yet. We're negotiating a trade-off, a commercial trade-off with an owner, whereas we will make less money on one angle, but more money in case the asset is being sold at a certain or above a certain price. So we try to be creative.
I mean, the problem, of course, with a quoted company is you want stable, maintainable earnings, though. So it may be,
As well.
it may be good, maybe the same cash for them, but in terms of what they're reporting, I mean, you talk to some of the people of let's say, companies IPO'd in the last 10 years, and their language changes dramatically depending on how you characterize that income.
And let's face it, we're publicly listed companies, us and our colleagues in the business, where the value of the business is based on the value of the contract. So there's a natural conflict here. The shorter the contract that we have, the lower the value of the contract, and if you calculate the domino effect of that, the lower the value of the PLC. So this is where I think the owner and the operator has to work a little bit creatively to try and
I think that's where established companies are burdened by the fear of precedent. To some extent, and so the consequence of that, there's emerging new companies that don't have the fear of all the other owners say, "What about me, mate? If you're doing that deal with Hilton or Starwood or Radisson doing a new favourable deal to a new owner, they have a fear of that being requested, and the dominoes usual were multiplied throughout the balance there is estate. So you have, ironically, that creates a competitive disadvantage to established brands.
I agree.
But it's a bit of a kind of the way the market is developing, and it's like a natural change that's happening, right? The same way travel agents used to have a shop on the high street or whatever. I mean, that changed. Now they are online. And the same thing here. The contracts are changing, and the management companies have to adjust to the fact that they're going to have to sign more short-term management contracts or franchise contracts rather than having a few a year, 30-year contracts. It's just a change of the way business is happening.
Well, I think it's playing into the hands of the third-party second-tier operators, isn't it, who are working with a franchise, short-term agreements, more aligned to the owner's interests, and with a franchise which can be either signed or terminated. And that's, I think that the model is changing towards that.
It's the market, yeah. If the market wants that, that's what's happening.
So let's talk. Let's sort of move more to the owner-operator relationship in the lead-up to a sale. I think it's simplistically hotels sell off multiples of profits. So it's in the owner's interest to maximize profits in that lead-up and during a sale process. So Gabriel, you're in an interesting position where you own hotels which are managed by companies that are nothing to do with Blackstone. You have hotels which are managed by Hilton, and you have owner-operated hotels. How do you see that dynamic changing between, are you able to, clearly you can influence things more when you're the owner-operator. Does that help you sell?
Yes, it does. We've been through, obviously, sales of all different types of structures, and having that flexibility or giving the buyer that kind of optionality, let's say, we've seen it, that it's worth, quite a bit.
But I'm not talking about the fact you can sell unencumbered or encumbered. I'm talking about being able to asset manage the asset better and drive better bottom line profit for the next owner.
Yes, because the more you can influence the P&L, of course, the better the bottom line will be. And what happens is when you don't have the ability, because contracts restrict you to get involved in day-to-day operational matters, let's say, you have less possibility to actually make that happen. I mean, you still, there's always it's very important to have a very good relationship with whatever the structure you have in place, be it franchise management or long-term management. Because you can still work very well, and we do have many hotels that are long-term management contracts, and we do also have a say on the way things are run. So I mean, I think if you're an active asset manager and you're the type of owner that actually likes to change things, and particularly in the case of private equity where you have to buy and sell within 5 years, you need to make changes during that first couple of years. So you have to have the possibility of influencing that. So if you have a long-term management contract, you have to sit on the table with the manager and try to understand and make them understand what are your interests and how they would ideally run the hotel.
So you tell them, we're thinking of selling this hotel, we're going to put it on the market. Do they play ball? Or do they just continue to run?
They do. I mean, for a start, it's obvious that, particularly in our case, they know that when we buy, we're going to be selling within 5 years or 6 years or whatever. So they know we're not long-term holders. But it's not something that you just decide and then work on it, 6 months prior. You're already preparing and doing everything for a sale from day one. From the day you close the deal, you're already doing everything and implementing everything that you put on the underwriting, which, as Desmond said, it usually doesn't work out that way. But anyway, you work towards the exit from day one. So it's already, everyone is aware, everyone related to the deal is aware.
I mean, can I touch on a cultural experience which I've seen in the whole universe of brands, so everyone should take this personally rather than a particular brand, is if you come in with a plan to do a shift change in the performance dynamics, whether it's driving the top line or conversion or control of costs, I've seen that brands spend a lot of time, because they're worried about saying, well, you're costing me 40% of revenue, and now you're going to cost me 30%. Am I going to get % in the corner for the 5 years that you were costing me 10% more than you should have been? And I still think the industry hasn't grappled with a way of forgiving and forgetting, and giving the confidence to the operator to work with the new asset manager or the new owner to get that repositioning done. And I don't know if that's a resonance of people in this room or on this panel, that it can be. It takes quite a lot of time to build trust that you're going to move forward and not keep, bringing up the sins of the past of our ancestors. And that is a challenge to get, the adaptation would be one observation. The second one is undoubtedly, in the last 20 years, the balance of understanding and insight and desire for control of owners has moved dramatically forward, rather than being the passive, let's say, operationally savvy investor. And I think some of the operating companies have struggled to adapt to the, let's say, the intellectual or commercial rigor that's being imposed upon them. And I think that's, again, another cultural hurdle that lay at the feet of the operators, that they haven't invested to keep pace with the evolution of the commercial insight and awareness of the investor. I don't know if you see that familiarity where people spend 90% of the engagement is arguing about how bad people have been, rather than saying, whatever's gone in the past, how are we going to adapt and make this value creating going forward? That's a long answer to your point, but I think about repositioning for an exit, you have to get, unless the operator's on board with that, you're going to be completely distracted fighting rather than creating value in the asset.
Yeah, I have to say, if you look at 300-400 years back, 500 years back, and go back to today's business, hotels by nature are not commodities. Hotels are not built as commodities. If you go back to history, they have become commodities probably in the last 40, 50 years, where there's a lot of trading. People built hotels, kept them within the family, from father to son to grandfather, and that has been the nature of the business for decades and centuries. And yes, the investment world has become increasingly more sophisticated over the last 50 years, and there has been this evolution of sophisticated investors. And I agree with you, Desmond, there needs to be an adaptation from the operator's angle in terms of this new sophisticated era of investors. But fundamentally, if you look back to history, the business is not a commodity. Buy it like gold, or you buy it for one, sell it for two. It's not the real fundamental nature of the business.
Okay.
And this is where I think there needs to be some education to the owners as well, to the new era of owners. It's not a commodity.
Yeah,
the fundamental component of this business is just not there.
The only thing is that I agree what you're saying, but At the end of the day, it's real estate and it generates an income,
Sure,
and
sure,
that's
sure, sure.
that's all that drives.
Of course, business.
And I guess bigger picture, whilst there are slightly conflicting sort of positions when you put all the parties in one room, the good news is, based on what we've seen certainly in the UK market in 2013 and continuing to 14, is that we are finding a way to merge all these different interests together and construct a solution that works for all parties, because we are seeing the portfolio trades in the UK, we're seeing the large single asset transactions. You know, we're lending into those structures as complex or vanilla as they may be. So we are collectively finding a way to work through what are quite complex areas.
Let's, so then the other big area, I suppose, in terms of structuring a sale is financing, which has been a significant issue over the last 5 years. I think it's fair to say that over the last possibly even 3 months, the financing market has changed significantly, so I think it's less of an issue. Andy, why don't you kick off? What will give us your sort of big picture view of the lending environment today, and maybe RBS's position in terms of new lending and facilitating transactions?
Absolutely. So I think, I'm not going to sort of sit here and try to say that through pre-financial crash that the level of our activity was consistent, because I know that not to be true. But what I would say from an RBS perspective is that I can genuinely say we've consistently been active in the sector. We've tried to stay close to operators, stay close to strategies, to understand sort of longer term strategic plans of clients and be ready to support them when we can. I'm very pleased to say that in 2013, as I alluded to earlier, it was the most active year we've had for some time, and that's across a range of asset classes, be that some of the larger portfolio transactions that happened last year. We were lending in at significant levels into those transactions. We're providing development finance. I can see people in this room who we're supporting in development finance projects in the UK, brand entries into the UK. So I think across the spectrum we are lending. I don't think what we're doing now, I would say, is traditional senior debt financing. We are not straying outside of our mandate and trying to be all across the capital structure. We are, I hope, people are seeing us be consistent across the senior debt market, both in terms of leverage and pricing. And I think we are as flexible as we can be around some of the very sensitive areas we've been talking about here, when you have owners and operators and different parties who are looking to the equity story and the future exit. We are trying to be as flexible as we can, whilst ultimately retaining an eye on our exit as a lender, which is either repayment or refinance.
Can I make an observation? And again, I don't know if this resonance with anyone else in this room, but there's been a trend in the last 18 months where there's big auction processes, whether it's for big Marriott portfolios or particularly in the UK, large portfolios, Malmaison, the other ones, for the deal jockeys, whether it's a broker or investment banker, to try and coordinate a debt package. I think in their own well-intentioned way, trying to be helpful, but actually I think that has been distortive and disruptive to the marketplace, because it sets in my own mind an expectation that can interfere with the genuine borrower relationship, because as you know, sponsor is everything. The asset and collateral is important, but presumably sponsor and the borrower is vital in your A, acceptance of the lending, and B, in the pricing of that.
It's the sponsor and equity is hugely important, but I would carry equal weight to the management team, because ultimately we reliant on the management team to work the asset or the portfolio to deliver ultimately the free cash flow, which is really where our focus is. The cash flow coming out the bottom of the P&L that can service our debt. So I think the equity sponsor, the management team, ultimately it's basic stuff. That the strategy, how is this project going to deliver the free cash flow that's going to service our debt structure? What's the target audience?
I think my observation is also about whether it's a good thing that the deal brokers try and facilitate with staple debt. Do you get involved in those staple debt games? Or
I think staple debt is, I don't think there really is staple debt. There's a couple of wonderful phrases. Credit education is a buzz phrase that's going around at the moment, or I've even heard people talk about blue tack financing, which is a slight variation on the theme. But I think I've seen good examples. You know, I've seen good and bad
Seen it
examples
work.
of that process. I've been involved in processes where it's worked very well. Sometimes you look at the parties involved and think you could get to the end result in a equally as efficient way with less people around the table.
So in two owners at the end, in your Starwood Capital days and Blackstone, to what extent have you been selling with either assumable or staple financing?
That's a good question, because in selection of debt that we put on assets that have been programmed for disposal, where we're taking an asset, repositioning it and saying, right, once it's up and running and the cash flow is proven, we'll flip it out. Having a bank that really understands the asset and can it will never guarantee, but can proffer some degree of transferability or assumption, is a very big tick in the box for the lending we're taking on, because that's going to again going to take away risk and uncertainty from a good exit. So I think it's an important point.
As a buyer now...
That's different from what I was talking about, staple debt in an auction process.
Yeah, no, I understand.
Where some guy who's never borrowed money phones
Yeah.
up, a few banks, spooks them all, and gets some crazy bid in from a DB, a BAML, and a City, and says, there you are, margin 700%. We've done some staple debt for you, and actually disrupts a fair, competitive borrowing market for them. So it's not that's stapling at closing rather than a good transferable debt package.
Right. Well, Gabriel, how much have you sold with debt transfer to the buyer?
We haven't sold actually with in-place financing as such. We did have cases where we sold and the same lender that was actually the lender to that asset lent to the buyer, which I think it makes a lot of sense, because not every buyer will want to inherit your same loans facility and so forth. So by having the same lender, that guy already has all the due diligence done, or at least partly done, and it will be a simple process, and they can agree on their own LTV and all that sort of details on the loan. So it helps in that sense. Another thing that helps, of course, is when the financing markets as such are favorable and they're coming. I mean, we've seen over the last, I think, 18 months that they're starting to come back. And I think that helps sale processes in general, as well as pricing, because when you know that a buyer would be able to have options of financing and actually well priced, that will help them price the asset better, so they will be buying it better from you. So it's in general terms, I think it's helpful.
Let's talk about sales strategies. What about the great debate? Do you fix the hotel and spend the capex, wait for it to stabilize, and then sell, or do you sell the dream, or do you? What's your experiences as owner and operator actually?
As an observation, it's not an experience because we don't own our hotels. If I look at our existing portfolio and the 30, 40 hotels that I know of today that are in the market, the ones that are in a good condition, where the capex has been spent on the properties and they are well maintained, are the most sellable and or have been the quickest properties to sell in the last 12 to 18 months.
So I would say that most buyers contact us wanting turnaround situations.
True.
That's the sweet spot.
My observation is the other way around.
Well, I think it's it depends, because turnaround means capex that is needed for upside and for increased revenues and so forth. I think Eli was referring as well to capex that's missing on structural issues, building problems, and that sort of thing. So I think you can choose whether to leave some of the upside case for the new buyer if you choose to do that. But what I think is crucial is, as an owner and a seller, that the building and all the structural side of things and all the back office, that's in pretty good order, because you can try and play smart, but at the end of the day, it will come back and you will end up paying for it anyway. So to have that, as much as you can within, in good condition, I think it's important. On the other capex, in our case, being private equity, it's almost by definition, we buy something, we turn it around in the sense of repositioning it, putting a lot of capex in, and then we sell. So in most cases, the hotels are well capexed in that sense. That's our business model in general. depends on what.
So when you sell an asset that doesn't need capex because do you buy the same way you sell?
Well, it's not doesn't need capex. Remember, it's an asset that's been capex 4 years ago, right? So it's still in good condition, but a buyer 4 years later will be able to say, well, I can change this, fix this, the carpet is a bit dated, I can change that. It's not fortunes, but they just adjust and they can either decide whether they want to, step it up and maybe move it one notch, higher and get more rate, or they, it's their option. But my point is, there will be assets that are not, what I think it doesn't work is when you try to sell assets that have issues in many other areas rather than just having a few, soft furnishings that are wear and tear and so forth. So, of course, when you can. I mean, if you are in a situation where you had some issues in some investment and it didn't go well, and you have some assets that are just collapsing, but you just cannot improve them, then you have to bite the bullet. But you will pay for it. I mean, the buyer will be factoring that in anyway. So.
I think it really depends on what's the equity story of a buy and who is the buyer, basically, because as a private equity fund, you are like the equity story is to buy, reposition, turn around, and sell. For pension money, for example, they don't want to, run into capex risk or upside risk. So they like to have a position hotel with a long-term return and stable cash flow. I think what happens is there are different cases on just having the capex just to maintain existing cash flow, like the maintenance capex and structural capex, and the new, in France we have a lot of new rules and regulation in fire safety and disabled people and things that needs to be spent at some point, and it's purely defensive. It adds no value. So, as you're saying, as a buyer or as a seller, you should factor that in. And then there is the repositioning capex, which brings more upside. The fact is that a few years back we could finance that. In today's market, we've noticed that the capex financing for future upside is very little leveraged, and we have to underwrite 100% on equity. So I think there is with the transferable of debt, I think if the upside has been there is a refinancing that has to take place once the hotel is repositioned.
Would you provide that debt, or you're saying it's?
No, well, we're borrowing that debt.
Okay, as owner.
As owner.
But as operator, would you?
Well, we don't provide that, but we can accompany some of the owners and say, okay, we're gonna lower our fees and make more fees when the hotel will be repositioned. We have a sort of earn-out or a kickback exercise to say, okay, we believe in the repositioning program. We are not going to burn the cash flow during the refurbishment and repositioning period, but we like to take part of the upside story. So some of this kind of facility we help as an operator, but as an owner we're playing the game of a repositioning risk.
I mean, financing capex, is interesting debate. I mean, from a senior debt perspective, the sort of basic rule book, if you like, will tell you that you lend against existing sustainable earnings. So financing of earnings enhancing capex is potentially a head scratcher, but we are doing it because we are looking, I suppose, and taking it to the extreme. A development finance for a new scheme coming out of the ground is the ultimate example of you are lending and buying into future earnings of an asset. So I think it comes down to, again, distilling it back to the starting position, it's having the confidence as a lender in the management team to deliver on the plan, because ultimately the investment of capex is for future earnings. And we've seen some, I won't call them turnarounds, but we've financed some acquisitions last year where there is very much a story where the earnings are on a high growth profile, and a lot of that will come from the investment of capex, and part of that investment in capex will come from senior debt that we're providing. So I think it is finance that is available in the right circumstances.
Have we got any questions from the audience? None at this stage? Okay. This is Gabriel and Desmond. What have you learned? What have you learned from the sales that you've you've completed over the last 2 to 3 years? Where have mistakes been made that you'd do things differently now? And I'm thinking,
Well, I'm sure
Well,
mistakes are never made or acknowledged as a matter of principle. The next round of fundraising, I mean, where can it even further?
I don't mean, you know,
created?
you just simply, these are sort of things within your control. So
Right.
was it
I mean,
right to
I'm
do?
not far be me to flatter a broker, but I think actually it is quite important if you go through a process. Is it just one of these questions where I'm supposed to say
You're going the right way.
broker right? Even unscripted, you sucked us into that
Yeah,
vortex.
exactly. We all call it HVS as soon as we think about selling.
I do think it's important, not to flatter your trade or some may say profession, that it is quite important that you do choose someone with relevant experience. And we have had a history, I've seen clearly, never in my own personal experience, I have seen people appoint brokers as a kind of return favour for helping me out on the last deal. And that's pretty catastrophic, really. You need to have people who are relevant in the market, probably as much know more about the likely investorship than about the particular asset or location. So if this asset is in central London and you know that, you know, the 400 American funds that have drawn cash and with number jockeys in London trying to find something desperately, you want a broker who's going to access those as much as sending it out, you know, by email to the usual 30 suspects. So that's a pretty important part of the process. And I think to answer the, I mean, partly addressing the other point, I think I distinguish where we used to have a phrase which is called manufacturing core, where you take complicated or incomplete assets. You know, one in Warsaw that you helped us with, and it springs to mind. We didn't have to wait till the stabilised income came before we sold it. We certainly had to do the capex work to take that risk off the institutional investor who was going to buy it, to know that that brain ache and the distraction was all out the window. They could form their own hockey stick of how long it would take to get stabilisation where that would be. But I do think brokers are, it's a decision that I've seen people take far too quickly and flippantly, and you do have to go through your interview process. One point. The other one, the don't underestimate the value of a rifle shot. The fact you're having an auction doesn't mean you have to go to 12,000 people. Particularly, I mean, look at the process without wanting to blame, of course, anyone that's an anagram of the IBRC, but they forced a lot of people to go do a lot of work, a lot of research. And I think a lot of people would have put quite a bit of money on betting who the winner was going to be in that end. And I kind of said, well, please don't waste my time next time, because if you're going to sell to an overbidder, just go straight to that person. So we have, or let me say, I have seen circumstances where the process could have been reduced by a significant fraction if you'd gone to the likely buyers list of 10 rather than going to all the 400 people.
I think I'm right in saying that you work for an organisation now that is actually probably put off by a broad formal process.
Well, I tell you what we find interesting are failed processes, because that by definition has eliminated a lot of the time wasters and the tire kickers. It doesn't mean that it will be a failed process in the end, because if we buy it and there's a willing seller, then we've achieved that objective. But it does make for extreme inefficiency. I would never suggest that we'd do the same thing, but I have heard stories of people hiring secretaries to go on to VDRs and pretend to be looking at stuff. So you can tell the manager that process, we're doing a lot of work on the VDR room. Because there's the pomposity of now the bidders being audited for how much effort they put in. Scores out of 10. Yeah. This person spent 1,000 hours, looking at all these different pages. They're really, really serious. Where in fact the poor old secretary is downloading. So there is an element of unintended consequences of the rigour that some of these over-managed processes are forcing people to go through. But we do like busted auctions, correct?
And I would say as a broker that one of the most important things to achieve an effective sale is for the seller to really know what they're selling, and it's amazing how often they don't. And to have all the relevant information completely ready and to hand. And I've worked for both of you guys. Starman is sort of the ultimate seller in some ways, and is a very, very organised organisation and just knows everything and has everything to hand. And it's so important to achieve a successful sale. Same with Blackstone. It's amazing how many out there that just don't ready themselves for a sale. And that's just so critical to, there's nothing worse than losing momentum in a process because the buyer finds something that seller isn't aware of. Worse
I tell you what we haven't touched on is reps and warranties. The other thing I was thinking about the other day.
Yeah.
I don't know if people have seen a new phenomenon of banks saying, not me, Gov, you're buying it as is. It's been in administration, there's no guarantees, no reps and warranties, as is, where is, good luck. And at the same time, your lender, maybe the same bank, is saying, well, where's your assurance that there's no pension liability or other unforeseens there? And I said, don't worry, there's a mate down at Lloyd's of London who'll give you warranties, indemnities insurance. Now, for those that are not familiar with this, you effectively buy a sort of a phantom finger crossing exercise that you pay a premium. And the reason I think it's an interesting process, I was mulling this over. I don't know if anyone's actually made, I'm interested to see if anyone's actually made a meaningful claim on a W&I policy. This is a warranty indemnity against the phantom underwriter of all the promises and undertakings of a non-existent vendor. And that's just curiosity. I'd love to find out if someone's ever made, because clearly, through good luck and judgment, none of the fears have come to fruition. But again, if anyone's got some nice, juicy stories, I'd love to hear them afterwards. You can't share them with me now, because it must be the most lucrative line of insurance to write. If everyone's paying like 1 or 2 million every time for these loans that these chaps are still dumping off, and no one's ever brought a claim, unless they got to the claim and said, I'm sorry, we read the detail. Well, actually, there's no assurance that we're going to pay out. So I think that's an interesting part of the evolution of the sales process. You must have seen that in a number of deals, particularly where you have
increasingly.
An uncertain vendor covenant.
Well, I mean,
without naming names.
a PE fund who's with a closed-end fund is looking to close its fund. So they don't want to give a fund guarantee.
Has anyone got any examples? I'd love to hear a juicy story of anyone successfully making a W&I claim. Other which I might buy shares in that broker.
That's what we always have to tell the buyers, right?
Yeah.
Why bother? Don't ask for any reps and warranties. It's never a claim. So
Go and buy a W&I policy.
Yeah, we try, but they don't.
Well, we've reached the end of the time. Are there any quick questions anyone's got? One, yeah.
Just Dan here from JLL. Just wondering, you're talking about the balancing of sort of maybe the balancing power between the owner and the operator, the management contracts. Do you think that existing operators, existing owners, when they start to see this balance changing, they're going to want some changes in their management contracts too? And is that possible?
I think that was a concern that I think that it causes inertia in the long-established brands, that they may understand and sympathise with the new investors' requirements, but they are worried about the what about me reaction across the existing owner base. And that probably makes it more difficult for those brands to be flexible on new deals than the emerging brands that have no legacy established contracts to be revisited.
Yeah, it's difficult to change an existing contract unless it has to be a very fair trade in terms of what you give in and what you take back. But moving forward on new contracts, I think the operators, whether the big five or the emerging operators, all have to engage into a creative mindset today if they really want to stay in this business in the next 5 to 10 years. It's the nature of the game now.
Mm-hmm. Yeah.
Anyone else? Okay, well, thanks, panelists. Thank you, everyone, for attending.
Thank you.